Hi, I'm Mario Pompeo. I'm a partner in Cohn Resnick Advisory, and I currently lead the CFO advisory practice. As you all know, this series of short webcasts is intended to help CFOs plan for the changes to processes, systems, and controls that are likely to occur as a result of the new revenue recognition standard. In this third video of our four-part series, we're going to focus our guidance on selecting a sample of contracts with customers, applying the standard to that sample, and conducting an impact assessment. I hope you find these insights helpful.
Welcome to Cohn Resnick's Accounting Standards Update webcast series focused on ASU number 2014-9, Revenue from Contracts with Customers. Hi, my name is Mario Pompeo, and I lead the CFO advisory practice within Cohn Resnick. This is our third part of a four-part series on the new revenue recognition standard, and I'm looking forward to taking you along on our continued journey to implementation. We will begin our discussion today with a high-level review of the first two webcasts. As we discussed on our last two webcasts, the joint effort of the FASB and IASB results in aligning U.S. Generally Accepted Accounting Principles, or GAAP, and international accounting standards with a few minor differences. The standard's core principle is that revenue recognition depicts the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods and services. Again, while this sounds pretty straightforward, it is important to recognize the fact that the changes can be huge depending on the industry that your company is involved in, as all prior industry-specific guidance regarding revenue recognition is eliminated. Furthermore, the new standard significantly increases the revenue-related quantitative and qualitative disclosures required in financial reporting. The FASB's guidance affects any entity, public, private, or not-for-profit, that 1, either enters into contracts with customers to transfer goods or services, or 2, enters into contracts for the transfer of non-financial assets unless those contracts are within the scope of other standards. While we've discussed this before, I just want to remind everybody that for public organizations, the standards is scheduled to become effective for all annual reporting periods beginning after December 15, 2017, and non-public organizations will implement the standard for all annual reporting periods beginning after December 15, 2018. As we also discussed, organizations can select from two different methods of reporting, the full retrospective method as well as the modified retrospective method. In our last webcast, I presented a transition timetable that Cohn Resnick recommends for companies beginning the transition process and highlighted that the time to get started is now. In the first two webinars, we covered the first 4 steps in our journey. The first few steps included identifying project sponsors and the change management group, while also building an implementation task force. In our second webcast, we covered the training and education of the organization's personnel, and we also discussed understanding the key revenue streams, accounting policies, and various treatments within the organization. Today, we're going to discuss selecting a sample of contracts and applying the new standard, and also conducting an impact assessment. Given that the impacts of the standard extend far beyond technical accounting, the level of preparedness or lack thereof within each company could be a cause for concern, and rightly so, as most companies will see at least some level of change. While most public companies will not start applying the new guidance until 2018, preparing for the change will likely require significant effort that can entail a substantial amount of time, and that is why Cohn Resnick has been suggesting that getting started early is the right way to approach this new implementation. As calendar year-end companies begin to wrap up the year, they should continue the transition process by undertaking the following steps: selecting a sample of contracts and applying the new standard, and conducting an impact assessment. We'll dive into each of these steps a little bit more with the following slides, but with the cold days of winter coming upon us, well, most of us, there is an ideal time to stay inside and enjoy a warm cup of hot chocolate while reading contracts and applying the new standard. Cohn Resnick advises all companies to consider the impact of the new standard. General assumptions should not be made about the standard's impact or lack thereof based on broad industry categorization. While we believe that the industries that are likely to be impacted by the new standard may include software, engineering, construction and real estate, aerospace, telecommunications, and asset management, the changes will not be limited to these industries alone. The reality is that all industries will be required to at least assess the impact of the new standard, determining if there is a gap between current accounting and that proposed by the new standard, as well as developing an implementation plan to address those gaps. The best way to begin assessing the gaps is to apply the new standard to a sample of the company's existing contracts. Companies should look for similarities and differences between recognition processes under current guidance and the new standard. They should also consider how business processes and systems might need to change in order to gather contract data that you may need on a going forward basis in order to comply with the new guidance. And you should consider the need to update accounting policy documentation. Applying the new guidance, a 5-step approach. The revenue recognition model focuses on 5 steps that provide context for what actions every company or organization should take. Identifying the contract, identifying the separate performance obligations within those contracts, calculating the total transaction price, allocating the transaction price to the performance obligations, and recognizing the revenue. Step 1, identifying the contract. A contract is in the scope of the new standard if all of the following conditions are met. The parties have approved the contract and are committed to performing their respective obligations. Each party's rights regarding the goods or services to be transferred can be identified. The payment terms are identifiable, and it's probable the seller will collect the consideration to which it is entitled, and the arrangement has commercial substance. If a contract fails to meet all of those criteria, the ASU takes a very harsh view with respect to the accounting. In other words, no revenue is recognized until any of the following occur. The seller's performance is complete and substantially all of the consideration in the arrangements has been collected and is non-refundable. The contract is terminated and the consideration received from the customer is non-refundable, or the 4 conditions noted previously are subsequently met. Step 2, identifying the separate performance obligations. It is not uncommon for a company to sell multiple products and services to its customers in a single transaction. Existing GAAP describes when certain individual elements in an arrangement can be unbundled, allowing for revenue recognition upon delivery of each product or service. The current rules vary on an industry-by-industry basis. The new ASU replaces all of these industry-specific guidelines with a very specific principle. It requires that a seller identify all specific performance obligations within a contract. Once this is done, the seller must allocate a portion of the total contract price to each distinct performance obligation. Once the company satisfies a particular performance obligation, the value assigned to it should be recognized as revenue. A performance obligation represents a distinct product or service within a broader contract that the seller has promised to deliver to a customer. A product or service is distinct if both of the following criteria are met. 1, the customer can benefit from the promised good or service on its own or together with other resources that are readily available to the customer. And 2, the promised good or service is distinct within the context of the contract. For example, the good or service isn't being used as an input to produce a combined output specified by the customer. It doesn't significantly modify or customize another good or service in the contract, or it isn't highly dependent on other promised goods or services in the contract. Step 3, calculating the transaction price. This step can be challenging, even in fixed price arrangements. This is due to the fact that the new standard requires companies to consider potential discounts, concessions, rights of return, liquidated damages, performance bonuses, and other forms of variable consideration when calculating the transaction price. Variable consideration should be calculated using either a best estimate or expected value approach, whichever is expected to better predict the amount of consideration to which an entity will be entitled. When developing the ASU, the FASB acknowledged that there can be significant uncertainty involved in estimating variable consideration. As a result, the FASB introduced the concept of constraint, specifying that variable consideration only be included in the transaction price to the extent that it's probable that a significant reversal won't occur. Note, the ASU requires a company to first estimate the total amount of variable consideration from a contract, and then, as a second independent step, a company will have to evaluate how much of the estimated variable consideration should ultimately be included in the transaction price. Also, the transaction price should be adjusted if the arrangement contains an implicit element of financing. When a customer contract contains a significant financing component, a company is required to adjust the transaction price to give consideration to the time value of money. As a practical expedient, a company does not have to account for the time value of money when the time period involved is less than 1 year. Step 4, allocating the transaction price to the performance obligations. The process for allocating the transaction price to the distinct performance obligations is similar to what's done today in many industries and is based upon the relative standalone selling price approach. Thus, the company should try to first determine the standalone selling price of each of its performance obligations. This can be straightforward if the business routinely sells the product or service on a standalone basis to similar customers. However, if an entity doesn't sell a particular performance obligation on a standalone basis, it will have to estimate the standalone selling price. Some techniques to make such estimates include a top-down approach, where a company can work with its sales team to develop a price it believes the market would be willing to pay for its goods or services. In doing so, the company should consider its standing within the marketplace. For example, is the company a market leader, meaning it can command a premium price, or is it a new entrant, in which case it may have to discount its prices? A bottoms-up approach. A company can also estimate the standalone selling price for a good or service based on a cost-plus methodology, estimating its costs to provide a good or service and adding a reasonable margin for its production and selling efforts. And lastly, a residual method. If the standalone selling prices of one or more of the performance obligations are highly variable or uncertain, a business can use a residual approach. In estimating the standalone selling price, the entity should maximize the use of observable inputs where available, including the published prices of competitors, etc. Step 5, recognizing the revenue. Finally, the company will recognize revenue as it satisfies its performance obligations. Put another way, revenue is recognized each time a company transfers a good or service to the customer and the customer obtains control over the delivered item. While these principles seem straightforward, they may result in very different patterns of revenue recognition compared with current GAAP. There are also some special consideration. Refund rights. When a good or service is sold together with a refund right, a company should record revenue for the transferred goods or services in the amount of consideration to which the company expects to be entitled. Therefore, no revenue would be recognized for products expected to be returned or services expected to be refunded. A refund liability for any consideration received that's expected to be refunded, and, as applicable, an asset for a company's right to recover products from customers on settling the refund liability. When revenues are recognized over time, the ASU allows companies to measure performance using either input measures or output measures to justify its recognition policies. The ASU also addresses some other issues, including the types of contracts that can and should be capitalized with contracts with customers, and contains complex guidance around the accounting for contract modifications. As we look forward into the early part of 2017, this is the time to figure out what things will most likely look like under the new standard. This is also the time to begin the process of modifying contracts and accounting processes, if necessary, to make sure that your company's financial statements continue to present an accurate and consistent picture of your operations. Understanding the key revenue streams, accounting policies, and the respective accounting treatment is critical. The overall impact to each and every organization will vary considerably. The only way to know how your organization will be impacted is to begin the impact assessment now. Some of the things to consider during the impact assessment will be the number and diversity of the company's contracts, the complexity of those contracts, the availability of revenue-related data, the number of systems and processes involved, and/or the amount of change expected across existing systems and processes, and finally, the availability of resources, particularly people resources, will have an impact on your implementation throughout the upcoming year. The impact assessment considerations. A large number of companies have not even completed an initial impact assessment at this time. An initial impact assessment enables an organization to determine the required timeline, costs, and resources needed to implement the new standard. Without having completed an assessment, companies may not have enough information to proceed effectively and efficiently with implementation, and it's important to note that any companies planning to utilize the full retrospective method of adopting the standard will need 2016 information. While many believe that the financial statement impact to their organizations will be small, it is a bad idea to make such an assumption without having completed a formal impact assessment. Several organizations already expect that there may be some level of change as to how they conduct business on a going forward basis. Communicating early with stakeholders, investors, lenders, etc., to explain these changes is highly recommended. Systems changes are also likely to be pervasive. So, what are the next steps in our revenue recognition journey? As we approach the end of 2016 and begin thinking about 2017, it is important for you to get started if you have not already done so. With approximately a year left before calendar year public companies are required to adopt this new standard, there is still time to take appropriate action. Hesitating any longer is risky. If you have not done so, please review our 2 webcast presentations on the new revenue recognition standard, which are in our archives, and continue to follow along with the final webcast presentation, where we will focus on the next steps in the continued implementation process, specifically commencing the conversion process and implementing and embedding new processes to comply on a going forward basis. Again, I'd like to thank you for joining our webcast, and I look forward to seeing you in the 4th and final installment next time.